Hi, everybody. My name is Behnaz Kibria. I am Senior Policy Counsel at Google, and I work primarily on cloud policy issues. I am the moderator for your very last panel. Congratulations to all of you for having made it all the way through. This has been a really great conference, and I want to say at the outset, thank you to the organizers for having us and for doing just a bang-up job. We are standing between you and lunch, so we're going to try to keep this hopefully short and sweet, and we'll dive right in. I'm very, very honored to be on a panel with these gentlemen. I'm going to let them introduce themselves, and if you will, just to sort of set the landscape, just say a little bit not only about your origin story, but also what the ways in which your organization intersects with fintech. Chris?
So I'm Chris Calabia from the Bill and Melinda Gates Foundation. And the Gates Foundation believes very strongly that each person deserves the chance to lead a healthy and productive life. It's hard to lead a healthy and productive life if you don't have access to healthcare, medicine, vaccinations, education, and increasingly financial services, because people who are forced to live in a cash-based society or cash-based economy lack the protections and the resilience, the financial resilience, to protect their families against unexpected downturns. And so we take a strong interest in financial services for the poor, is the name of the team that I work on. And technology has been a big game changer, as I'll mention in a few moments. And prior to joining the Gates Foundation, I was a supervisor at the Federal Reserve Bank of New York for 25 years.
I'm Eric Belsky. I'm the Director of the Division of Consumer and Community Affairs at the Federal Reserve Board in Washington, D.C., therefore a regulator in this space. And I'll use this as an opportunity to make the standard disclaimer that the views I'm going to share are mine and not necessarily those of the Board of Governors of the Federal Reserve.
Great, thanks. My name is Don Gayhardt. I'm the CEO of CURO Financial Technologies. We're a predominantly online lender, consumer lender, based in Wichita, Kansas, but have big offices in Chicago. And about a third of our business is in Canada, so we have an office in Mississauga. Although I live about 12 miles from here, so I was welcome the opportunity to sleep in my own bed and be here with you today. Thanks.
Armen, Meyer, Vice President for Public Policy at LendingClub. Great to be here. LendingClub is the largest personal loan installment lender in the country, doing roughly facilitating $1 billion loans per month now, $1 billion in loans per month. Longest term, think 3 years. Think larger amounts, $15,000, and selling those loans on a marketplace so that they don't remain on our balance sheet, to bring a diverse pool of funding to the loans to reach a broad credit spectrum, so selling it to about 100 institutions once they're originated from a bank from which we buy them. So looking forward to the conversation.
Thank you very much. And so we come at the very end of your 2 days here, and all the good talking points have been talked, and all of the good debates have been had. So it falls on us to sort of scan the horizon and think about the future of fintech. So the first question for you all, and I think all of you are going to have a perspective on this. A significant part of the innovation in the financial services industry over the last decade has been attributable to big data and growing technological capacities to draw insights from that data. What, in your view, is the most promising aspect of big data use by fintechs in the future? And conversely, what is the most troubling? And I know Max talked a little bit about this when he was talking about sort of the lens that his company is going to sort of ensure that the models that they use are audited and not subject to discrimination as much as possible. But what are you all thinking about?
I guess I'll start because I have the microphone. So Max did touch on it earlier. It was also touched on yesterday, and I thought some important research has come out of the Philadelphia Fed actually begins to address some of that. By looking at LendingClub and others' data in the industry, they've seen that the use of non-bureau data has allowed a decline in FICO scores among those receiving loans, but still no increase in default rates. That's a combination of technology, our models, and frankly the use of non-bureau data and bring our own attributes, and I'm sure others in this room do this as well, have their own proprietary attributes. It's important, though, to say that what Max said about can't do it as articulately as he can, but it's not like there's this crazy black box that can't be explained. It is important to know that a lot of these attributes are things that are derived from bureau data or given to us by the borrower or cash flow data given to us by the borrower on consent. Just those fairly modest increments on Bureau traditional data makes a big difference, and I think is why we saw the Philadelphia Fed study come out that way. On the perils, I think, on the risks of it, you know, we kind of made a big deal about the black box, and we kind of make a big deal out of we don't know what the algorithm's going to do. But I think the honest truth is we don't have to look to the future on this one. We can actually look to the past. I mean, disparate impact analysis has been around for a while now, and fair lending law has been around for a while. And give the regulators some credit. A law that was done a long time ago is actually just as applicable today in an era of models and non-bureau data as it was decades ago. Because at the end of the day, we would much rather be accountable for our outputs than have to have a conversation like began to start yesterday when I think a regulator raised his hand and said, wait, you want prescriptive inputs? No. What we want, we want the opportunity to show that alternative data can help people, and we'll get more of those Philadelphia Federal Reserve research studies. The only way to do that is to not be hamstrung, but be accountable at the end of the day to make sure that we are not impacting folks in a disproportionately negative way.
Yeah, I think that I'd echo a lot of that. I mean, I think big data has certainly helped increase access to credit primarily by allowing for really sort of accurate and expeditious credit decisioning for customers below, you know, I say kind of a conventional FICO like 660, 680. You know, the rule of thumb used to be once you start to get below there, it's really hard to, and I think still is a rule of thumb, very hard to do on a FICO score alone. You know, you really need to have some additional data. Some of that is I think, attributable to the way the bureaus operate, and it was a lot of thin file, no file, below 660, 680. I think one thing I would point out, though, that I think the bureaus, and again, I'm not here to be the sort of defenders of them other than we'll simply make a point that I think they do kind of understand this, and one thing that they all have done is bought kind of what we call kind of alternative finance bureaus that specialize in doing deeper, you know, getting deeper subprime data aggregation, and I think it's helping to sort of fill out the files for customers that are in the mid to low 600s and below that. And I think but I think Max's point was spot on about the transparency. You know, we try to tell people all the time, there's nothing we do that's not replicable. Probably the only thing that we have about 70 million completed loan applications in our own database, and that's obviously really powerful data for us. But beyond that, we're aggregating stuff anybody could go out and aggregate, and making sure that people understand that it's not. And we say machine learning helps us. Machine learning, it helps us test credit models and back test stuff in a much more expeditious way than we used to be able to do. Beyond that, machine learning, you know, we're not letting a robot make a decision. I mean, it's all decisioning based upon stuff that has a lot of human elements and human inputs into it, and the technology helps you sort of just test it and validate it. And ultimately, I would argue, to the extent we've had conversations with regulators about this, make it easy to explain to a regulator and a policymaker how the credit decisioning is meant, how the models really work.
So thank you. You know, I would add to the conversation that from a regulator's perspective, big data presents, from our perspective, real opportunities to expand access to financial services, to reduce costs of underwriting, the speed of approvals, and convenience. When I think of big data, though, I think about it really in maybe three buckets. One is a set of data that's behavioral, and some other data in nature, some of which may have you know, a clear and understandable connection to credit worthiness, and some of which, you know, has a less understandable connection to credit worthiness. Those would be things like, you know, the time of day you're on the internet, the websites you visit, the college you attended. And those are the kinds of things where when you see potentially less of a clear connection, that financial institutions have to be aware of the potential fair lending risks to the extent those are correlated with race. Then there's a second sort of set that really look at payment data, but not repayment of loan data, things like utility payments, rent payments, paying your phone bills. And that's something that people have been exploring for some time. It hasn't really been used in a widespread way, but it's seeing increasing use and has, a connection in obvious ways to people's financial lives. The third bucket is cash flow data, which has a very even clearer connection to people's ability to repay loans. So in a lending space, we think of that data as data that has promise, and we're starting to see that promise in some preliminary research from things like FinReg Lab, which looked at, I think it's 5 or 6 online lenders and looked at the performance of cash flow data. Specifically, was it predictive in the way that credit scores are predictive, and found yes, very, very similar in terms of the predictiveness, and didn't appear to be something that raised fair lending concerns in the data and among the firms that they were looking at, in the sense that these things had predictive power that were independent of protected classes and factors. So we think it has real potential. Obviously, when you have data coming out from the CFPB that you have 25, 26 million people who lack a credit score, and you have another maybe 15, 16 million that have not very well-developed credit information in their credit reports, this really does have the potential to make that kind of difference. And we also see big data being used in ways that are helping customers manage their financial lives. Their savings would be an example, ways to look at cash flows and find opportunities with their support where they can roll those into savings instruments, and just generally get alerts about when they're about to make a purchase, where they are in terms of balances, things like that. So there's a lot of potential in the use of cash flow information, we think.
And I would just pick up on some of the points that Eric just made about the people who lack appropriate, say, credit scores or credit histories. In some of the markets in which we work in, people have zero data, or traditionally had zero data available about them. So if you think of the 1.7 billion people who don't have access to a formal financial services account today, 1.1 billion of them don't have any way of proving who they are. There's no identity, to the point that was raised earlier by our colleague from Brookings Institution. And in lower income countries, that can be 30 to 90% of the population that can't prove who they are. It's particularly troublesome for women, who tend to lack identity at higher rates than men. In some cultures, in some countries, girls' lives' births are not recorded. And so it's really hard to develop, say, a credit score if you have no way of proving who you are. That said, the data that mobile network operators gathered from these populations has been really helpful in helping them understand a little bit better about these consumers, because even in countries that you and I would think of as being very poor, you will see multiple cell phones. Huge numbers of people have cell phones of some kinds. They're not Samsung Galaxies or iPhones, but they are basic cell phones that can do basic things and send text messages and increasingly payments. And so these mobile network operators became aware of this data, realized that they could perhaps underwrite payment services and take deposits or deposit-like transactions from these customers and help them engage in payments. And that's been a real game changer in terms of financial inclusion.
And what about perils or challenges?
So the other side of that is, so suddenly there's a huge amount of data about a population that may not well understand their rights and responsibilities, may not be literate, may not even be numerate. And so they are at a huge disadvantage when they're dealing with these types of firms. In addition, with things like geolocation, we know better from the graphs that were shown earlier, the pictures that were shown earlier, we know where these people are and who they associate with, essentially. And so in the wrong hands, that information could lead to discrimination against different groups of people or particular minorities or ethnic groups or religions and so on.
Like the social score situation. Yeah, exactly. So I'm hearing you guys say, access obviously is the big promise. On the downside or the perils, obviously transparency, but maybe it's not quite as daunting as we may otherwise think. And then certainly the bias concerns are real. Let's turn now to the question of regulation. Obviously financial services is a highly regulated industry, and the trajectory of fintech can be significantly affected by the decisions the regulators make about its use and governance. And I thought it was particularly interesting, I think it was John Ryan who said this morning, that they are accomplishing more through their adoption of technology than they think they are through their advocacy. And I know that for us as cloud service providers, that certainly rings true for us as well. I mean, it's been really great when we've had, like the SEC talk about the 5x gains they've had in fraud detection, because they've really relied upon machine learning in their approach. Or you have FINRA that is largely lifted and shifted its operations to cloud. It's AWS, but but still, it's important movement. And so, I can't agree more that it really sends a strong signal to the market about technology adoption when things like that happen. But what do you think? What is in your future is what in your view is the future of regulation, both in terms of use and action by regulators? And Erica, as a resident regulator, we'll start with you.
So I was glad to see on a number of slides the term responsible innovation come up. I think as a financial regulator, certainly as the Federal Reserve, we really support responsible innovation, full stop. And the question is, how do we do that given a set of regulations that have been governing the market in the division that I have responsibility for around consumer protection and fair lending laws? And our view of the broader situation is that there's just so many potential opportunities in fintech. We talked about the potential for expanded access, and we're seeing expanded access, but there's a whole host of others. You mentioned one, using AI in a way that can help detect fraud, in a way that can help with BSA AML compliance, to basically use AI to thwart cyber attacks that are AI in nature. It's kind of, so fundamental and central, I think, to where the financial services industry is today, and more particularly where it's headed. I think when I think about it more generally, we have, as I said, a regulatory framework, laws passed by Congress that protect consumers in a number of ways, and fair lending laws are one of them. Unfair or deceptive acts or practices, unfair or deceptive or abusive acts or practices, which the CFPB has rule writing authority for beyond the Federal Trade Commission, UDAP, the Federal Credit Reporting Act, just a whole series of these things, and as I said, fair lending laws. And so I think when you think about the whole role of fintech within this, I would say more broadly what we find, because we supervise financial institutions, is that the overwhelming majority understand the regulatory framework. They know what it takes to comply. They're successful in doing it, and they look at innovation just like any other thing, and they say, let's make sure that we're doing things to be compliant. And we heard a lot of that in the last 2 days of really strong efforts to be compliant. So we think banks have that experience. And you also, though, have the case that some fintech firms may be less attentive to some of those compliance aspects of what they're doing. But from the banking perspective, they can't outsource compliance. They are responsible for compliance. So a very significant part of this that makes this both consistent with the framework we've had, but an area that we always see as potential risk is when banks are working with third parties, and they are extensively with fintech partners, that they understand the way that firm is meshing with their consumer compliance supervision. And every agency has guidance about how to manage their relationship with vendors, and they understand the expectation is their responsibility for compliance risk. And I think as they're deciding who they're going to partner with, they do look at a lot of things, including what it seems like the compliance posture and strength of the firm itself is. So in that regard, I think that there's a lot of this looks similar to what we've seen before. I think to the extent that it involves a bank getting into a new product area, especially one that may be beyond their normal risk appetite, it's another area that is standardly seen by regulators as high risk. And the only other one that I would mention is the question of alternative data, because clearly there is great potential in the use of that information, but it is one that you want to be cautious about whether it may be something that exposes your customers to and your financial institution to fair lending risks. But banks are in the business of risk, and the expectation is they're going to manage those risks, and it's very important that they do so. So I think the regulatory, set of laws we have, the regulatory framework, can leave some questions in people's minds, and what regulators are trying to do is be as clear as possible about those things, because we're in constant communication and outreach with firms, and we're trying to understand where we may not be clear and try to therefore be clear. You heard, lots of the agencies have office hours and other things. So that's the way I think about it. I think the future for fintech is very bright, and I think it fits within the set of laws and regulations that we have.
I think that it's interesting. There was obviously a conversation with Max and others about banks and fintechs, and I use merger in the sense of not a legal sense, but just in sort of as they kind of start to stream together more. And I think there is I was on the board of like my term will finish at the end of this year, Beneficial Bank just down the street. We merged it with WSFS. Actually, we're in the Ed Bainey Auditorium. He was one of my fellow board members at Beneficial for a long time, was the head of the Philadelphia Fed here. But I think there's how the bank, I think you have a set of existing bank regulations and bank regulators that are there, and I think that as fintech continues to kind of modernize and the businesses start to scale up, and there is how these partnerships work out, and whether it's the bank acquires a fintech or they're just lending on someone else's platform. I still think it's going to come more and more under the regulatory frameworks that sort of already exist from the commercial banks and the Fed and the OCC and the FDIC. And I think generally that's a good thing. I think if you would ask a lot of people in fintech, they probably would recoil a little bit in horror at the thought of that. But I just think that's kind of where it's going. And having been on the board of a bank for a long time, I sort of have had a kind of a good seat at that. And while everybody would like fewer audits and fewer this and fewer that, it's just kind of the world we live in. And I think if you're going to have a business of scale and size that can raise capital and have a long-term trajectory, I think you're just going to have to understand that's going to be part of the environment. And we have it with the state regulators and with the CFPB and a whole bunch of other things that we already do. And I just think having it more sort of fully under the sort of banking regulations is what I think. Again, I don't know whether it's 3 years or 5 years or 10 years, but I think that's kind of where it's going. And I think in general, it's probably a good thing for for those of us who are on the fintech side of things, that ultimately, and those of us that are kind of prepared for it, I think are going to ultimately kind of benefit, and it could end up being really a competitive advantage to be able to do that.
So the best thing about a panel called The Future of Fintech is we can say whatever we want, and 10 years from now you won't remember. So let's go out on a limb here. So I had 3 ideas of what the regulatory future could look like. Thank you for stealing mine. That was a great one. I couldn't agree more. I got to come up with a 3rd one when we get there. But to your point, it is good for platforms to be regulated like banks, because it is all merging together. So I just want to agree with that, and I think it's good for all of us in the room ultimately. The other 2 I would say are, one, we talked a lot about transparency on the last panel. We talked about how in California, a group of us, LendingClub and some of the folks on stage before, Opportunity Fund and Funding Circle and our coalition, the Responsible Business Lending Coalition, passed a law in California. Small business is part of our portfolio, as was explained on the past panel. Passed a law in California in order to provide more transparency, so you knew what you were getting into as a small business taking on a loan, with protections that are somewhat like what consumers get today across the board, according to federal law and TILA. So we talked about on the last panel, and I think we should even go further than we discussed on the last panel, seeing more states now do that beyond California. But I think the answer is, and this is one where I think we can agree that a federal standard really makes sense, is that a TILA for small business at a national level, I'm going to put that on the prediction bucket for 5 to 10 years from now. It's just so inevitable with online lending, so inevitable with the benefits of transparency and access to credit for businesses. How could we not demand of ourselves a national standard on transparency? I think that's an easy one. A harder one is probably, second prediction is, so John Ryan might have agreed with that one. He's not here. He'll disagree with this one. There is a Federalist compromise here. rate caps made sense once upon a time at a state level. We really probably need a 36% thoughtful approach across the board, that as opposed to each state picking a random number out of their hat as a rate cap. That's really, there's no reason other than some historical vestige for that, for these random numbers, and they frankly do a lot of harm on access to credit than they do good at this point, because Congress has already come around the beginning of a 36% standard according to Military Lending Act passed 2006. The CFPB very recently adopted a rule with a 36% standard. Some of that was repealed, but some of it is still in place, frankly. Their dichotomy between above 36 and below 36 still stands for some portions of the CFPB's rule. And the FDIC, we've seen issue guidance saying, hey, above 36%, be cautious, be thoughtful. So this has been coming around, and there's bills in Congress, there'll be more, I'm sure, this year emphasizing this. This is an appropriate place for a federal standard. There are places where it's less appropriate. There are times where you want the states. I was a former chief of staff of New York's bank regulator. You do want the states to have power to go beyond federal law, especially in times of fluctuation administration, and to let the best rise to the top. Rates is not one of them. There are great examples of non-premise state laws around servicing and conduct standards and mortgage servicing that really led the way and pioneered national standards. Those are good examples. So I think some compromise on federalism, I'll put that in the 10 to 15 year bucket, and thank God you won't remember I said this 10 years from now, but let's go with that. I need a third one. The third one will be on Madden. So Mike asked Max 2 panels ago about this case called Madden versus Midland. This is now the other side of the platform. Now not on the lending side or loan facilitation side, we're now on the investor side. In order for this market to work, for marketplace to work, you need a great U.S. secondary market for loans. I mean, that is the envy of the world. That is why our financial system is so awesome. Europe would kill to have it, other than their balkanized state-by-state approach, nation-by-nation approach. But we're kind of shooting ourselves in the foot with this crazy case out of Second Circuit that says, oh, wait, hold on, forget all that for the last 150 years. If you bank sell a loan to a non-bank, and they made this exception, they focus on debt collectors, then therefore all the preemption powers or national standardization of that loan now goes out the toilet the second it goes to a non-bank in another state. And I mean, what a crazy system to run a national economy on, that you change the driver of the car and suddenly all the rules change about the car. So in order for this system to work, I think we need a national standard on Madden. And I do predict with force that Madden will either be reversed and we'll go back to the old days of a true national marketplace for loans in the next 10 years, or it will be cut back so much by courts within New York, and doesn't even get to the Supreme Court, with all these cases coming down the pipe now, where now securitizations can't be done in some of these plaintiffs' cases, because a securitization is a sale to a non-bank trust, and now it matters which state the borrower was in. Whoever buys those securitizations, the user rate's going to change now, supposedly, for all these securitizations. So I predict that either the courts in New York will take care of this problem, or the Supreme Court will take care of this problem eventually, with some help from regulators.
So I would just add to this that colleagues on the stage here have all talked about the importance of the federal and state regulators who are involved in the supervision of financial services here in the United States, and that's part of the brilliance or genius of our dual banking system. But in other countries, actually, there are a wider number of regulators getting involved in this, and that's partly because of the fact that the mobile phone is so important in emerging and developing countries to financial services. And so increasingly at workshops that I'm leading or attending, participating in, I will see the national telco regulator in these sessions. And so, Jalava, maybe a tip for you, at the 4th or 5th FinTech conference, you may want to invite a telco regulator or someone from the International Telecommunications Union to come and talk about that, because these relationships are now being formed between central banks, the regulatory authorities, and the telco regulators that never existed before. And that's because the telco providers offer the platform upon which these services are offered, and ultimately the telco regulators are the ones who are responsible for the security of that platform.
I think that's a really interesting point, Chris. And I think from the cloud standpoint, I think we sort of have similar questions about, kind of a little bit to Armen's issue about, platforms should be regulated as well. Like, who will be the regulator? A lot of platforms aren't specific to financial services. As we look at questions even here in the United States about, for example, critical infrastructure and the importance of cloud to financial services markets and others, is it a financial services regulator that then, if there is a call to have further or additional regulation, is it a financial services regulator that takes the reins? Is it DHS? Is it another agency that has, other types of oversight? It's a really, I agree, it's a very interesting question for the future of regulation. And one more issue. I don't want to dwell on regulation because we have a little bit more to go. But a number of you have talked about fintechs meeting regulatory requirements. One question that remains in my mind is, to what extent are the regulatory requirements and regimes doable? And how much of them can remain the way they are, and how much really just need to change? I won't ask you that because, let me do this. If you want to answer that question, you can, but I'll move on to something else as well, so you have a choice. Chris, I kind of wanted to start with you on this question because you've got a unique perspective on this. But I'm talking a little bit about impacts. I know we've touched on it a little bit already. But access to digital finance, financial services is a core element of the Bill and Melinda Gates Financial Services for the Poor program. What is your assessment of the impact that fintech has had so far on the unbanked and underserved? And as these technologies continue to expand, what are the opportunities and challenges ahead?
Absolutely. So I'm going to use a broader definition of fintech than maybe we're using today to include telco providers, because they've been really the innovators in the spaces in which we work. If you look at the surveys on the number of people or the portion of the population that has access to financial services, the World Bank does on a triennial basis, in 2011, about half of the entire world had access to some kind of formal financial services account. And as of 2018, it's about 2/3 now, about 68%. If you look at lower income countries, though, the numbers are dramatically lower. In 2011, it was 13% of people had access to a formal financial services account. By 2018, it improved, but only to about 35%. So a big improvement. Still, there's a lot of more room to go, especially for women. About 1 billion of the 1.7 people who don't have access to financial services accounts are women. Most of them are in Africa. And so there are big things that we need to do there to address the gender gap, which has been persistent throughout all the studies that the World Bank has done, and we're not quite sure why that is. So at the foundation, we're spending a lot of time thinking about what cultural and perhaps also regulatory issues may exist there. I think in general, though, the countries that have had the most success in terms of expanding access to financial services have adopted a multi-part approach. And so one is policy innovation, and that's rethinking the regulations. That's everything from licensing firms, what kinds of firms are allowed to provide services. How is KYC done for consumers who may have no ability to prove who they are? So there's something called tiered KYC in some countries. It's a little bit about how people get their cash into the system, since there are no branches in most villages. And so you would go to a third party that might take cash on your behalf and then enter it through their own personal mobile phone into the financial system for you. And so these are some of the policy innovations. But I think the most important technologies that have driven the increase in access have been, first of all, around identity, again. And so perhaps the most famous example is India, which has adopted the Aadhaar system several years ago. They now have 1.3 billion people registered through this, and they have their fingerprints or retinal scans registered. And I've seen the tremendous impact this has in terms of just being able to get access to financial services. Myself, I stood in a branch and watched someone just walk up to the counter, put their thumb on a thumbprint reader. They were authenticated almost instantly, and 2 minutes later, they had an account. And that's how easy it was for them to open the account. So identity is a huge technology in this space, very important. And the Gates Foundation funds some World Bank research currently looking at design principles for national identity systems. And we've also developed an open source platform that's available to anyone to use if they would like to adopt a modern digital identity system. I think the second technology, which I've already alluded to, which has been critical, has been the use of the mobile phone. I won't spend too much time talking about it other than the fact that ownership levels are incredibly high, even in very poor countries. And this is probably the way that we will get to most of the rest of the people who are unbanked today. The third technology that I mentioned that's been really important and is probably the geekiest technology I'll mention right now is interoperable payment systems. So I know it'll come as a shock to people in the United States that some non-banks are not allowed to access their national payment systems. That was a joke. Okay, right. Okay, so sorry. Room full of central bankers, sorry. So I know in the United States we don't allow that either. But in many countries, that is a challenge. If you're a new provider, whether you're a telco, whether you're a fintech, whether you're a social media platform, getting access to that national payment system makes your product valuable. Otherwise, the only people that your customers can transact with are other customers. And so the Gates Foundation for some years has urged countries to consider the development of interoperable payment systems. And because we got a lot of pushback years ago when we were advocating for this, commercial banks would say, well, this is our platform. Why should we let these non-banks in? Or new providers would say, why should I build a platform that my competitors can use? So we sponsored research to develop a reference architecture for an interoperable payment system, which is now available on GitHub today. It's called Moja Loop, after the Swahili word moja for one or together. And you can download it today, and it can form the basis of a new national payment system. It's being deployed commercially by 2 mobile network operators in Africa and 22 countries jointly to connect 110 million accounts across 22 countries. And one central bank in East Africa is adopting as well as part of its national payments grid, and other central banks are evaluating as well. So interoperable payment systems are a big part of the technology that has the biggest impact, I think, in terms of access to inclusion. But remember, all these things have to be paired with an enabling regulatory environment. And so I lead the foundation's work on regulatory reform and having conversations with academics, with lawyers, with regulators and industry people about how we can ensure that these systems evolve in a safe and sound manner, in a manner that protects consumers, but still allows for innovation.
So I'd say very quickly, in my remarks, I was speaking a lot around, my experience with consumer protection laws and fair lending laws in terms of the regulatory framework. There are, of course, innovations that, do raise lots of questions about the which agency should regulate, how do you coordinate if it's more than one agency. So I think that's important to acknowledge and recognize, though there are certainly issues like that. Chris is working on this globally. I hope he's also thinking about it domestically, and I'm sure given his long experience domestically, he is. I would also just comment on financial inclusion. As I said, the ability to help people manage their financial lives through fintech is really powerful and is already starting to be used. And one regulation I didn't talk about, but it's another regulation that's important when it comes to financial inclusion, along with fair lending laws which promote financial inclusion, is the Community Reinvestment Act. And with respect to the Community Reinvestment Act, obviously when you have so much activity starting to occur where banks don't have physical locations, but you have a regulation that was formulated around assessing activity where banks have branches, to the extent more and more of that activity is taking place both on the deposit acquisition side and on the lending product side. Outside of those places, it's why the 3 agencies who have responsibility for this are, very actively working on thoughts around how to modernize the regulation, and that's one of the reasons to try to do that.
I mean, we're at the Philadelphia Fed. You can't not plug Philadelphia Fed research on this exact topic that came out over the past couple of years. Jalapa, you may know this author. One author found, looking at marketplace lending loans, that marketplace loans are actually among the highest in concentration, no shocker, in areas where they found bank branches are pulling out as measured by HHI, which I have no idea what that stands for, but it's a concentration of banks regionally. Jalapa can explain that later. But anyway, so I do think that the power to reach underserved communities is there. I think it can actually be better. And the way to make it better is actually goes back to Don, your point. The more the systems, and they are converging, so it's not a bold prediction to say they're going to converge between banks and platforms. The more that happens, the more that Fintechs can help banks reach more people, can bring new revenue sources to banks by partnering with them, whether it is a LendingClub model of we sell loans to community banks across the country, take advantage of their, obviously they have a low cost of capital, so we give them high quality loans. They are now able to get new revenue sources, reach people they would not have but through our marketing channel, frankly. But it can go all the way to the white labeling we talked about yesterday with TD Bank and Avant. That's also a way to expand access to credit. And then, frankly, if there is a charter one day, to your point on CRA, there has to be a financial inclusion plan associated with those charters. And LendingClub has spoken pretty loudly on this. You don't want you don't want the benefit of that system without the obligation to come with it. So those are just a few examples.
I'll just make one point based on my bank board experience about the sort of, it's a scale issue, I think, a lot for smaller banks. And I think one of the reasons why we thought Beneficial and WSFS as a combination made sense is, if you look at Beneficial, we had about non-interest expense was about $150 million a year. And J.P. Morgan Chase announces they're going to come into Philadelphia and start opening branches. And J.P. Morgan Chase spends $1.3 billion per year on technology and innovation. So, they spend 8 or 9 times just on technology and innovation than what Beneficial spends to run, the whole branch network and compliance and marketing and et cetera, et cetera. So, and a lot of the smaller banks, it's just sort of a scale issue. Have had to sort of cede the consumer lending side of it over to the fintechs, and I think that the over time, I think it really is something that's, I don't want to say health or I make predictions about. Again, maybe we can make predictions. You're right, where nobody's going to remember what we said, but it really is kind of critical to certainly the smaller, the community banks, the larger community banks, the smaller regional banks, to have some of these partnerships that can help the consumer lending side of things, because otherwise you're left in the commercial and CD&I side of things where it's just ferociously competitive, and Beneficial is trying to compete with insurance companies, et cetera, coming into the market here and making real estate loans at ridiculously thin margins, and it's just hard to compete in that environment over time.
All right, so Jalapa standing, which is the universal sign for we are out of time here. Thank you guys so much for having us. Thank you all for participating.
Yep. Thank you.